Hello guys, this is Matthew from Commercial Deal Junkie, and we're going to be going over cap rates and how they affect commercial real estate property. It's kind of like the fundamentals of commercial real estate, kind of the basis you need to understand before you really start understanding the nuances of value add commercial real estate. So what is a cap rate exactly? So a cap rate is essentially the expected return of a piece of real estate. So if you have a piece of property and you're expecting an 8% return on the value of the asset that you should be able to receive as your net operating income. So again, the cap rate does not include the mortgage of the property. This is what your net operating income is going to be. From there, you take out the mortgage of the property. Now, what the cap rate really is it's a measure of a risk. The higher the return you expect from a piece of property, the higher risk the property is going to tend to be. Very, very safe assets will tend to have really low cap rates because the money is nearly guaranteed. For example, if you go buy a Starbucks with a 15-year lease on it, the chances that Starbucks is going to continue paying you for 15 years is really high. That's considered a really safe investment. As a result, investors are willing to receive a lower return in exchange for the confidence that they're going to actually receive those rent checks every month. So the safer the investment is, the lower the cap rate it trades at. Okay, so cap rate is it's your expected return, and it's a measure of risk. You're willing to accept a lower return on the capital you invest if you know the money's guaranteed. Okay. Now, how are cap rates chosen? How do you know what cap rate is going to trade for what property? At the end of the day, just like residential, it really comes down to comparables. If you're looking at a strip center here, you're looking at a strip center and it's a multi-tenant strip center, and one similar down the street sold at an 8 cap, your strip center likely is going to be traded at an 8 cap of the net operating income. And again, you get that net operating income divided by that cap rate, you get the value of the piece of real estate. All right. So what affects cap rates? How do you know, how can you improve your cap rate? What is your cap rate affected by? There's many things that affect cap rates, but these are the four that really tend to move the needle on cap rate, in my opinion. First is interest rates. Now, the reason I put that first is, we're in a higher interest rate environment right now, and you're seeing its effect on cap rates. It's very hard to buy a apartment building in Austin at a 5 cap when you're borrowing at a 7. So that discrepancy between cap rate and interest rates causes cap rates to expand, especially if interest rates are higher than cap rates. Cap rates will start expanding until they reach a new equilibrium. So as cap rates go up, as interest rates go up, cap rates will tend to follow, and vice versa. As interest rates drop, cap rates will tend to compress and go down. Next is tenant quality and terms. Like I said, Starbucks, if you have 15 years and you have a Starbucks, national brand, long term left, that's going to trade at a lower cap rate because it's safer. The stronger the tenants, the longer the terms are of the lease, and the more guaranteed that tenant is. Maybe they have a corporate guarantee, maybe they're a large company, whatever the situation is, the more likely you are to actually receive that money on a monthly basis, the lower the cap rate will be. Again, because cap rate is a measure of risk. As the risk goes down, the cap rate goes down. So tenant quality and terms of the lease have a big effect on cap rate. The next one is location. Location has a huge effect on cap rate. Okay, so something in a very stable, growing neighborhood will tend to trade at a lower cap rate than something that is not in a great neighborhood. Again, it goes back to a measure of risk. Now, before we keep going, I'm going to jump to my example here. So let's say you have an apartment building. This is my drawing of an apartment building. Okay, you have an apartment building, and the net operating income of the apartment building is $100,000. Okay, both buildings. There's a building in Kansas and a building in Miami. Same apartment building, same build, same rent, same everything. The net operating income is $100,000. This one, because it's in Kansas City, is going to trade at a 7.5 cap. Okay. This building, exact same building, exact same revenue, exact same tenants, is in Miami, but because it's in Miami, it's going to trade at a 4.5 cap. Okay. So the exact same building with the exact same tenants collecting the exact same amount of money is worth 1.3 million in Kansas City, but is worth 2.2 million in Miami. And yes, I rounded, so don't, you calculator nerds, don't come after me. So this exact same asset in two different markets can have wildly different cap rates, even if the building is copy paste. Okay, so location has a huge effect on the cap rate, which in return has a huge effect on the value of the asset. The next one that's important is building quality and building age. Newer builds that are in really good shape, that are built out with all the amenities, are going to tend to trade at a lower cap rate. The quality of the real estate, the age of the real estate will have an effect on what the cap rate trades at. Okay. Now, let's look at a strip center, for example. So you have a strip center here, Now, what are the major things in the leases of the tenants that can have a big effect on the cap rate? So let's say you lease length. How many years are left on these tenants? Okay, if you have a 4 tenant strip center like my beautiful strip center here, if you have the average lease term is less than a year. Let's say someone has 4 months left, someone has 8, someone has a year and a half, someone has 2 months. So the average amount of months here is less than a year. That's called the WALT, the weighted average lease term. What is the average amount of time left of each tenant? If it's low, you're going to see the cap rate go up because now it's a riskier deal. These tenants could leave. Again, cap rate is a measure of risk. So if the tenants don't have a lot of term left, it means they could disappear when their lease expires in a couple months. That's a riskier deal. Cap rate goes up. Tenant quality, guarantors. If you have a Dunkin' Donuts and then a Taco Bell, and then if you have super, super high quality tenants, you're going to have a lower cap rate because it's a safer deal. If you have John's Burgers and Christina's Nails, and if you have local mom and pop tenants, cap rates are going to go up. You're going to get a bigger return from that property because, this might be Christina's Nails. This might be their only location. So if anything happens, the main operator gets abducted by aliens or dies or whatever the situation is, they're likely going to default on their lease. So the quality of the tenant and who the guarantors are, as well as the length of the lease. Next one is location. And location can be narrowed down as far as not just as big as a discrepancy like Miami and Kansas City. It could be even the corner it's on. You could have a Taco Bell in a more low-key part of the city trade at a 7 cap, but then the Taco Bell on the massive street corner that everyone's crossing, that one might trade at a 5 cap. Why? Because, again, it's a measure of risk. So if Taco Bell were to leave at the end of their 10-year lease, it's going to be very easy to release that one that's at the street corner, even in the same city. But if it's at the hot corner of the city where all the people are commuting back and forth from, it's lower risk because the operator can now, if the Taco Bell somehow were to leave, they can go and they can rent it out to KFC or Starbucks or McDonald's or whatever the situation may be. So what it really comes down to is cap rate is a measure of risk. So if you're looking at a deal and on the front, they are showing off that it's a 10 cap, the first thing I want you to think is, where is the risk in this deal? Why are they offering a 10 cap? Likely means the leases are about to expire, or maybe the tenants are really, really weak, or maybe the location kind of sucks. So don't get excited about really high cap rates. Get excited about properties you can turn into high cap rates, but don't get excited. If they're literally telling you 10 cap, come buy this, and you'll get a 10 cap the day you buy it, first question you should be asking yourself is, where is the risk? And on vice versa, when the cap rate is really low, now you know, okay, there should be very little to no risk in this deal. If you see a Starbucks trading at a 5 cap, that's only 1 point above treasuries. So that has to be a very, very safe asset for you to accept the fact that you're only going to receive a 5% return. Okay? And cap rates, they're inversely related to each other. So that means as risk goes up, cap rate goes up. As risk goes down, cap rate goes down. The lower the cap rate, the higher the value of the asset. I know it sounds counterintuitive, but you're dividing it by the cap rate. You take your NOI and you're dividing by the cap rate. So the higher the cap rate, the lower the value of the building. The lower the cap rate, the higher the value of the building. Because that means investors are willing to accept a lower return on this piece of real estate, and they're willing to pay that and receive this return. Anyway, I hope that made sense. Cap rates, once you kind of internalize them and they become intuition, they become really easy to understand. But sometimes for people that are new to the game, it can be kind of difficult to wrap your heads around. I really hope you guys enjoyed the video. Be sure to like, subscribe, and follow along as I buy commercial real estate and grow my commercial real estate portfolio. Be sure to follow along, and I'll catch you guys on the next one.